Welcome to this week's video on where to invest your money. I'm Ross Jenkins, a finance director and an investor. So welcome to this week's video of Money in Life with Ross Jenkins. So the recent changes to the Cash ISA system, where the limit you can invest is decreased to £12,000. Let's look at the alternatives of where you can invest your money if you want to max out your ISA at £20,000. Even without these changes to the Cash ISA limits, actually investing in Cash ISAs is not the best use of your money, and investing has always been far beneficial for you. So let's look at where beginners can invest their money to build wealth. A UK Cash ISA is great at keeping your investments tax-free. However, it's not great at building wealth. This is because after inflation, you're actually not generating that much investment income. If inflation is 3% and your Cash ISA is only 4%, you're just about breaking even, which is why most people move away from Cash ISAs and actually start investing, which I will look at into more detail next. So investing in the UK is really simple. The first place you want to go is get a stocks and shares ISA. This allows you to invest up to £20,000 in the UK tax-free per year. If you max out this £20,000 allowance, then you want to open a general investing account, which can also be with the same broker that you use for your stocks and shares ISA. That's it. There's no need to overcomplicate it. Just open up your stocks and shares ISA first and then your general investment account second. So where can you invest your money? So the best place to invest is index funds. So this can be tracking the S&P 500 or the FTSE 100, for example, or a mixture of different global indexes. So you could invest in China, for example, or emerging markets, or America, and pick the right one that suits your lifestyle. So these funds are diversified, they're usually low cost, and they outperform picking individual stocks over the long term. So if you are feeling brave, you can invest in individual stocks. But as mentioned, actually, even if you're a professional trader, most index funds will outperform the market. So for example, if you bought the S&P 500 index fund and you then decided to actually buy individual stocks in the S&P 500, you'll find the index fund outperforms picking individual stocks, because not all stocks go up, some will go down over time. So I'm not telling you what to buy, but these are the common indexes that most people tend to buy when they start out as beginners. So if you invest over the last 20 years in the S&P 500, your returns are going to be far greater than if you invested in a Cash ISA. So for example, let's have a look at my graph that I produced that compares the FTSE 100, the S&P 500 and a Cash ISA. So for the Cash ISA, although the interest rates have been low, I have assumed a 4% return per year just to keep the maths really simple. And I've also included in this graph the inflation rates for the UK, so you can compare against all three investment methods. So as you can see from the graph, the S&P 500 is the biggest return on your investment. So this is doing £200 per month invested in all the alternative methods. So with the S&P 500, you end up with £163,000 after the 20 years. And this is from only investing £48,000 in cash. In the FTSE 100, your £48,000 would become £105,000. If you invested in a Cash ISA, although these rates are probably quite higher than what we actually have achieved, you would have £73,000. But when you take inflation into account, the inflation in the UK over the last 20 years for the same time period is £69,000. So actually, as explained earlier in this video, you're just about breaking even when you take into account inflation. So really the two best methods are to invest in the S&P 500, FTSE 100 or another index fund. So please remember, these returns are not guaranteed. This is just over a 20-year period for comparison purposes. So as explained in the last video, the reason the government has changed the Cash ISA rules is because they want more people to invest in UK shares. So although the FTSE 100 gain is less than the S&P 500, if more people actually invest in the UK, then these returns could be greater than what have been achieved in the last 20 years, although there is no guarantee to this. So this is why when you invest, you need to look at the long term. So in this example, we use 20 years, but the compounding interest returns from this is really great, which is why £48,000 can turn into £163,000. So you always need to look at investing as a long term. If you need funds for short term, less than 10 years, investing is not for you. So let's look at some of the UK common platforms you can use. So you've got Vanguard, Trading 212, which is the one I use, Freetrade, which is very relatively cheap, and Hargreaves Lansdown, which is more expensive but is very reliable and used by a lot of investors in the UK. So please pick an investment platform that suits you. You don't need to pick one with all the bells and whistles. You're just a beginner. You just need to start investing. So pick one that you feel most comfortable with and you're happy with the fees. It's more important to pick the right investments rather than picking the right platform to do your investments. So let's have a look at if investing is right for you. So first of all, you need to have built a 3 to 6 month emergency fund. So this is in case you lose your job or you've got a big repair in your house or something like that. You need to have savings built up before you can start investing. The second part is you need to clear all your high interest rates. So if you've got credit cards or loans, make sure these are paid off first before you start investing. So once you start investing, the easiest way to do it is set up an automatic payment method for every time your pay goes into your bank account. So for example, I get paid on the last working day of the month. So on the first of each month, I will set up a standing order to go into my investment account that can then be invested on a monthly basis. So it's important to stay consistent with this. So by doing it monthly, you're spreading your risk. So if investments go up or down during the months, then you're actually spreading this risk over the whole year, not just putting it all in one lump sum. So as mentioned previously, you want to invest for at least a 10-year period because investments can go up and down. As you can see from the graph, it's not just a straight line up. Sometimes they do go down each year. If you want me to break investing down step by step in future videos, please let me know down below in the comments. And please let me know how you invest your money currently. Please hit subscribe and like the video because it really helps this channel grow as I'm starting out. Thank you and see you next time on Money and Life with Ross Jenkins.